Hey everyone, welcome to our Beginner's Guide to Investing. If you're new here, you might be wondering, what exactly is an investing strategy? Well, think of it as your personal playbook for how to handle your money in the stock market. It's super important because without a strategy, it's kind of like wandering around without a map. You could end up anywhere. Now, you might hear people jokingly refer to investors without a strategy as sheep, or even say they're like blindfolded monkeys throwing darts. It sounds funny, but it highlights a real point. Investing without a clear plan can lead to random choices. Much like throwing darts at stock listings in the newspaper used to be a thing. Let's break down a few different styles of investing. 1. Passive versus active investing. Passive investing is like setting your investments on cruise control. Techniques like buy and hold or investing in index funds are popular because they have lower costs and you're not trying to beat the market's overall growth. Passive investors generally believe it's pretty tough to predict how the market will behave, and thus sticking with it over time tends to yield benefits. Active investing, on the other hand, is more like being in the driver's seat and zipping through traffic. Investors here engage in strategies like momentum trading, where they try to outsmart the market by predicting future trends. They think they've got the skills to perform better than average. 2. Momentum trading. This approach involves picking stocks that have been winners recently and betting that they'll keep on winning. Though it sounds straightforward, remember, evidence on whether this consistently works is mixed. 3. Buy and hold. Ever heard of buying something and just sitting tight? That's what this strategy is about. You buy stocks or funds and hold on to them for the long haul. It's based on the idea that despite some ups and downs, the market tends to give a decent return over time. 4. Long-short strategy. This one's a bit more complex. Imagine you pick a bunch of stocks, bet on some to go up long and others to go down short. It's about balancing your bets across the market. 5. Indexing. If you just want a slice of the whole market, indexing is for you. You can invest in something like the S&P 500 through index funds or ETFs. This can be passive if you hold long-term, or active if you use it to try to time the market. 6. Global markets. Investing isn't just local. You can go global by investing in developed or emerging markets. While places like the US or Europe might feel safer, emerging markets can offer high growth, though they come with their own set of risks, like political instability or less regulation. 7. Pairs trading. Think of this as matchmaking for stocks. You find two similar stocks and bet on the differences in their performance, hoping they revert to a mean. It's a sophisticated strategy and not for beginners. 8. Value versus growth. Value investing is about finding hidden gems, stocks that seem undervalued but have strong fundamentals. Growth investing targets companies that are expected to grow faster than average, usually at a higher risk. And remember, investing isn't just about picking stocks. It's also about strategies like dividend growth investing, where you focus on companies known for paying out steady dividends, or dollar cost averaging, which involves investing a fixed amount regularly regardless of the stock price to reduce risk. Lastly, for those who love going against the crowd, there's contrarian investing, finding value in stocks others might be overlooking because of current market downturns. That's a wrap on our quick tour of investing strategies. Remember, there's no one-size-fits-all answer here. It's all about finding what fits your financial goals, risk tolerance, and investment timeline. Thanks for tuning in, and don't forget to subscribe for more insights into making your money work smarter for you.